All right, ladies and gentlemen, here we go. Okay, welcome to September 26th. Okay, so how about this? Got about one more business week, and then it's the fourth quarter. So you know what I always say this time of year, and that's why I'm going to California this week, Arizona the next week, talking about business planning and so forth. It's time to do your next year business plan. Do it now. All right, so today we're very lucky. From Prosperity Mortgage, we have Mr. Thomas Miller. Thomas, if you could please hit *6 on your phone to unmute yourself, and then we can hear you.
Good morning, sir.
Good morning. Do you go by Thomas or Tom?
Thomas.
You do by – okay, good, good. I'm glad when they have it typed right in there. So, Thomas, tell us a little about yourself, what market you're in, maybe how long you've been doing this crazy thing called real estate. Please.
Sure. My name is Thomas Miller. I'm actually from Southern California. I cover the entire Temecula Valley. Very fortunate for myself, which includes Lake Elsinore, Murrieta, Temecula, and Menifee. So I've got 4 offices that I cover. Great place to be.
I'll be there Wednesday.
That's correct. That's correct. I'm actually looking forward to seeing you in Temecula. I am actually a transplant from San Bernardino. I have been in real estate since 2010. I was a lender for Wells Fargo for many, many years, and then decided to abandon ship when the market shifted last year. Was contacted by Prosperity. Loved the business plan that they had. Loved the model that they have and everything that they were looking to achieve with their launch out here in the Temecula Valley. So I was fortunate enough to be able to land a position here. Like I said, cover these 4 locations. I work with about 150 to 200 amazing agents. Also a father, married and father. I have 2 daughters. One is 14. She's a cheerleader at the local high school. Another one is just about to turn 5 here. My wife works in the medical field. Like I said, we're somewhat new to Temecula Valley. We've been here for about a year and a half. Absolutely love it out here. And just excited to be a part of Prosperity and, like I said, what they have going on.
Awesome. Well, that was a great introduction, too. I love that you introduced your kids, too. That's great. And, that's such a great area over there with our lovely managers. I'll be at Shannon's office, but you have Carol over there. You have our new guy. You have Joe. So it's a great area. It's a really great area. And like you said, it's a beautiful place to live too. I every time I'm there, I'm like, it's just it's one of those nice areas. It's in great shape. Traffic's not too bad there. So
yeah,
all right,
it's
cool.
Definitely growing. We're experiencing a lot of growth out here, a lot of building out here. So there's a lot of opportunity for real estate out here. Yeah.
Yep. It's a great area. The thing is also what you mentioned about Prosperity. I also look at. We were bought as a company. The Mark Stark companies were bought by corporate a little over a year ago. Year and 3 months ago. Year and 4 months ago. And then Prosperity. So we've had a few mortgage companies in and out. I love the fact that these are both owned by Uncle Warren. Okay, they're all part of the Berkshire Hathaway network, which is great. Which means they're set up for success. And when you said their business plan, I'm like, and their model, I agree, especially from you. I mean, coming from Wells Fargo, you guys have such a, I always joke around about the bigger banks. It's so much better for the loan originator when it comes to being a mortgage broker because of the programs and you're dealing one-on-one. You go right to the underwriting department, where with those big banks, you're just a number.
Correct. Absolutely.
Yeah. All right. So tell us a little. So tell us okay. So the market. Okay. Let's just get this out of the way. Hey, Thomas, the rates have gone up. Have you heard about this?
Absolutely.
Yeah, the rates have gone up. What are the rates?
I always tell our agents whenever I'm speaking with them, we don't really sell rate out here. We sell a customer experience. So right now, rates are pretty much uniform across the board. No matter where you go, you're going to get pretty much the same spiel. Do you want to pay a point? Do you not want to pay a point? Obviously, we're going to offer all the same loan options. What I really think where the difference maker is, like I said, the customer experience that we provide. Some of the products we have, like our $10,000 seller guarantee, things of that nature, they really just cannot be touched by competitors. So once you have, good loan officers, like I believe we have here, we have a lot of educated loan officers, guys with tons and tons of knowledge, people that have been in the business 20, 30 years. When you add that with a great product selection and people that are really trying to drive a good customer experience, it really dwindles your competition very, very quickly, I think. So We haven't really had much challenge with regards to rate, like I said, because our approach is very different. We don't try to compete with rate or win the deal with rate. We win it with, like I said, customer experience, options that we're giving our customers, different products and opportunities that they may have that are a little bit different versus if they take their business elsewhere.
Right. I agree 100%. Yeah. And it's the same thing with us. I mean, we're not a discount brokerage, and we do very well, and you guys do very well. So it's a great little a relationship, I think. And then with our title companies and escrow and so forth, it works out really well. And I'm seeing it getting better and better and better, and it will continue to get better. But the market, I mean, even though the rates have bumped up, I mean, the market's still moving. It's still very healthy right now, right?
It is. Absolutely. Real estate is one of those things, it never really stops. It experiences its peaks and valleys, but anybody who's been in this business for, more than a couple of years, you already kind of know that going in. And like I said, it's really just your individual approach to the market. Do you want to let the market beat you up, or are you going to go out and beat up the market? I kind of go for the latter. And like I said, it really just comes down to kind of your mindset. I listen to a lot of your reels that you send out on Instagram all the time, and it's very, very true. It really comes down to your mindset. I mean, if you have a positive outlook and a can-do attitude, it's very, very difficult to fail even in a market such as now. It's a little bit more challenging, and you really have to be on your toes. And like I said, you have to deliver a different experience than what it used to be. It used to be more driven around rate and who could get the best deal and so on and so forth. And now rates are pretty much uniform across the board. Everybody's struggling with the high rate. So now we're able to shift, like I said, a little bit and really dig into the experience that we're giving our borrowers. That being said, even if the market continues to go up, which it very well may, I'm very confident that we'll continue to be successful just because of the way we approach the market each and every day.
Yeah. Well, the Fed's hell bent. They're behind the eight ball, so they're trying to make up for it by, cranking that rate. I mean, you talk about going from one extreme to the other. I mean, a year ago, you can get 2.9, 3.1 in that range, and today. So, but here's the thing. Here's the thing that everybody in this market can't run from. The fact that, the last 15 years we've built as a country now, and it's very consistent with our area, California, Arizona, Nevada, where we've only built 25% as many homes as the 15 years prior, right? So we have an inventory, no matter how you slice it. So some people, and that's what I keep telling my agents here, some people may wait on the sidelines, which I don't agree with, because why would you, when someone says to me, well, I should have bought 2 years ago. You're right. You should have bought 2 years ago, but you didn't. And since we can't fly against the Earth's rotation backwards and turn back time, okay, now is the second best time for you to buy. So are you going to continue to penalize yourself by renting? It doesn't even make sense. So if I wanted to get the house I wanted, for like my family and for a period of time, the rate is temporary. Like you guys say, I love it. Buy the home, date the rate, which is great, or marry the home, date the rate, which I think is great. Yeah, I love that. That's so awesome. Right. But I mean, so now you have less competition. Hell, you could even get the seller to pay 2-3 points. And if you're putting over 10% down, even more, to buying down your rate so you can get a better rate. But still, so actually as a buyer, you have a better deal right now than you did 6-9 months ago.
You're absolutely right. And with that, we do see home prices decreasing. So with that $20,000 or $30,000 decrease, it's very easy to step in that same money that you were apt to spend a month or two ago when home prices were just a tad bit higher. You can put that back into your rate. You can still buy a somewhat competitive rate. Back in 2018, 19, when rates were sitting right around 4.5 to 4.75, I mean, people were buying homes like it was going out of style even then. One of the things that a lot of people I don't think they realize right now is that we've got a lot more inventory right now than where we did 2 years ago, and that was right in the middle of COVID. So there is a lot more opportunity out there, and with the way things are looking right now, rates continue to go up, so on and so forth. You're absolutely right. Why wouldn't you want to buy right now before the rates end up at 8 or 9%?
Right. Yeah, and the thing is that signing another year lease, renting is 100% interest. You don't get any of that, right? So it's still, and I know a lot of the younger people hate when I say this, but back in my day, when I got into real estate in 1985, if you could get a 12, 14% fixed, you were static. And then in my first house, it was 9.99, 1 year adjustable, with just 3 years after up to 2%. So I went from what you call it 10 to 12 to 14 before I refinanced it. But the rates came down. You can refinance. And a lot of people don't realize, like, let's say I'm 5 years into my mortgage and I refinance, I can get a 25-year mortgage. I don't have to get a 30-year mortgage again. I can do 25. So, there's all kinds of things that they can do based on this.
Absolutely. With the renting, I always tell people this very, very quick story. I bought my first home with a gift of $10,000. I did an FHA loan, bought it, sat on the house long enough, turned around and sold it, walked away with $200,000 equity. About 6 years later, bought my next home, which was almost a $500,000 home. Now it's sitting at about $750,000. It's an investment. It started out with $10,000. I've had some ups and downs with taxes going up and having to refinance and rates and so on and so forth. But I was able to be in the position I'm in now, sitting in a $750,000 home off of $10,000 of a gift. Was able to return the gift later on down the road. Like I said, walk away with $200,000 from the sale of my first home, put it all down on my next. I have a comfortable payment, nice home. It's a win. And rate really never factors into any of that because there's a bigger picture. You know what I mean? Right.
Yeah, and that's such a great story because people can go FHA, they can go VA, they can go even some of the conventionals. You can put 3% down. So really, if you have good credit, a good job history, just a little bit of money, there's no reason. I mean, basically, if you're going to rent a place, what they require to get in today, it's pretty close to what it's required, what you can get away with, basically, with buying a new home, especially if it's your first home.
Only thing they don't look at when you rent a home is debt to income. But there's still an income qualifier. There's still a credit qualifier. So really the only difference, like I said, that and you don't, but I mean, even then you still need somewhat of a down payment. You got to come in usually with first, a deposit, so on and so forth. So I use that analogy a lot. It's a very similar. I mean, you have to go through almost the same process. In some cases, if you're looking at a nice condominium complex that's recently opened, it could take you anywhere between 15 to 30 days to get everything done anyways. That's almost like doing a loan.
That's right. That's right, except you're going into a rental as opposed to your own property. Hey, there's just something to be said about owning your own house. It's a whole different feeling. When I started in the business in 1985, one of the things that got me to join it was called the American Dream. I still think it is, but you don't hear it. You don't hear it talked about like that as much anymore. The American Dream, which home ownership, owning your own piece of real estate, I think is pretty impressive and pretty wonderful. Like you just said, I mean, $10,000 down for $500,000 now into $750,000. You probably have a decent amount of equity in the property, and that's all from an initial investment. That's the thing about real estate. It doesn't appreciate at the money you put down. It appreciates at the total value of the property, which is way ahead of your money. Now, if it adjusts down like a stock market, well, sometimes it goes the other way too. But anything like the stock market or real estate, anything that you hold on to long enough, you're going to do well in. That's why you want to make sure, like I always tell, especially the newer agents I coach, you want to live below your means. Live below your means, not at or above, because then when the seas get a little rough, you could have problems. But if you have a little cushion, all right, then you'll weather any storm.
Words to live by in 2022.
See that? Especially in this world we live in when, I mean, I don't know about you, but I get a credit card offering every day, sometimes 3 or 4 of them, or, add 20,000 on this credit line you already have. And you got to tell people, that's not the best thing to do. Have a decent credit line. I mean, you should be more, I mean, I never used to do this, but I do now. I monitor my FICO score. I mean, everybody should be doing that.
Absolutely, I do too. As a matter of fact, I told my wife I had put something on a credit card the other day. I thought my score went down 2 points. She's like, "Oh my God, 2 points!" But it does, and a lot of people don't understand exactly how it works. And they're like, "Hey, what did I do wrong? I make all my payments on time. What just happened?" Well, if you've got a card and you get it close to the max, and it'll ding you up some points. So yeah, definitely some truth to keeping an eye on your credit score on a day-to-day, especially if you're thinking about going into the housing market. I can't tell you how many times people call me to get pre-qualified and you ask them, well, how's your credit? I don't know. I'm like, okay, well, it's going to be an interesting conversation. So, yeah, monitoring the credit is definitely a necessity nowadays.
It says so right on your credit. I mean, all you have to do is on your statement, like your credit cards, it monitors it for you. Now, I know they're not 100% accurate, but at least it gives you a ballpark.
Yeah, it gives you an idea. I mean, if you're sitting there, if you pull it up and you're at a 500, it's a good indicator that you're probably going to have a struggle ahead of you. But then again, you open up, even your apps like Credit Karma and stuff like that use the Vantage information, still give you a really good idea of where you are, if you're going to have any issues going forward trying to qualify for something, be it, mortgage loan, auto loan, any type of financing.
Yeah, absolutely. Absolutely. All right, cool. All right. So I think everybody has their own way of doing this. So I'm a buyer. I want to be pre-qualified in today's market. What's the best angle for me to go at? Obviously call you, and then what's next?
I always tell people, so my number one goal with the market being as competitive as it is, we take it a step further. We get you right past the pre-qualification, me just collecting your information real quick and running a quick application. I'll have you send me over some documents. That way I can verify everything. Again, making sure that I'm giving you a good experience, protecting you going into your escrow. If I give you a document saying, yeah, you're good to go, and I haven't looked at bank statements and I haven't looked at paycheck stubs, very, very difficult for me to hand you a document and tell you to go out and, make an offer on a $500,000 property. So we prefer to do it a little bit differently, get the application off the ground, obviously. That way we have a reason to request and start collecting documentation and then get that done extremely quick. In fact, right now we're doing pretty good. We're on about a 3 to 5 day turnaround, even with an active application. I had an FHA deal that was from submit to appraisal and conditional approval within 4 business days. So we're moving along right now.
Yeah. Yeah, I know that I work with John Ingram. He's been right here at St. Rose at the headquarters here ever since I've been here, and he does a fabulous job. And I've sent my friends to him and so forth too. And I know the last one I refinanced mine. What was it? 2 years ago now, 3 years, whatever. When the rates were like the lowest, he said, because I told him, call me when you think it's the lowest, and he did. And all I had to do, if I remember correctly, was give a bank stub, and everything else was online. I'm like, how do you do that? Right. So today it's pretty easy to pre-qualify.
Correct. With the technology in place that we have now, we're able to pull your verification of employment automatically. In some cases, we're able to get bank statements. You can, when you're doing your electronic application, you can actually give the application authorization to connect to your financial institution, to your employer, so on and so forth, so that we're able to automatically retrieve those documents electronically, which definitely helps speed up the process. Gone are the days of having to go in and sit down with the lender for an hour and take a box of documents, so on and so forth. Not to mention, right, even with the documentation processes, things kind of shifted from 2008 off of the stated income to us verifying things. It's still really simplified itself over the years. We've been able to kind of narrow it down, two bank statements, 2 paycheck stubs, 2 W-2s, and 85% of your borrowers are probably good to go.
That's awesome. That's awesome. It's wonderful and scary all at the same time.
It is. But I mean, it safeguards the business, and it prevents us having another 2008. As we all know, the lending world played a very, very large role in what happened in 2008. So with the regulations that are in place now, we know that that's not going to happen again.
Yeah. And that was everybody's fault. Realtors, banks, loan originators. I mean, I'm from the Northeast, and I know a couple of banks I dealt with. A few of them are still wearing orange. Let's put it that way. So there's a lot of fraud and things.
Those Bear Stearns guys out there out of the Northeast, they were in a bad position.
Designer orange.
Exactly.
Yeah. So, but and that's the thing about today is what people don't realize is that none of those indicators are there. I know people are talking about a bubble, and I know people are waiting on the sidelines. What I think is going to happen is this is really just a mental. In other words, people are thinking because of everything going on right now, the market's going to tank. So you may see some people build up on the sidelines and let loose as the market, when the rates start coming down again, because they will. It's an election year. Okay, so they're going to adjust at some point. It's not going to keep going. I don't know that for a fact because, the Fed's doing this, and this administration, they're doing some stuff I can't even figure out. I'm like, I own a calculator. This does not make sense. Houston, we have a problem, but I don't get it, but who knows? So we don't know what is going to happen. We just know that as far as everything but the base rate and the interest rates, the market's healthy as hell. So I'm sure we're going to come out of it looking good, but I know there'll be some people on the sidelines waiting to see some adjustments. And I mean, it's the same thing with the stock market, right? So it's just something you can't run or hide from, or nor would you want to. But ultimately, still a healthy market.
Absolutely. And you're very right. We do hear a lot of people, well, I'm waiting for prices to go down. There are some people out there that really and truly do believe that 2008 is going to happen all over again, but there's so many indicators to tell us to tell us the opposite. We've got inflated inventory that we didn't have back then. We've got loan regulation in place now, so that really there's, nobody's holding on to the amount of bad loan and bad debt, which was really the catalyst for why all that happened. The banks are so heavily regulated by the Fed now. It's absolutely insane. Going back to the Wells Fargo, I mean, sometimes trying to get deals done, you're better off, pulling your own teeth out on a day-to-day basis. So there's so many different elements that are not in place. And it would be unfortunate for people to sit out here thinking that things are going to happen and that homes are going to drop back to 200,000 or 300,000. Unfortunately, that's just not a reality. I think the 10 to 15% marker that we're hearing is probably going to be somewhat accurate. I agree with you on the rates with the election year and everything. It's just kind of fishy, to say the least, Rick. What I'm thinking is probably sometime towards the beginning of the year, if not a little bit sooner, right after the election, they're going to have to slowly start to back the rates off. They're slowing the market. They really are. So, and I know that there's an end-all, be-all goal of trying to keep us out of recession and trying to reset inflation. But if you listen to the Fed's address last week, they're talking about not doing anything until seeing us back at 2%, and a comfortable marker for them, they said, would be 4%. Well, we've only moved about 0.5% in the last 2.5 to 3 months, so that could give you an indicator of how long we could be looking at rate hikes. Sooner or later, it'll just end up stopping the market altogether, and that's not what we want.
Right. But my only concern with this Fed is that they're hell-bent on – they're only focusing on one number, inflation, because that's what the press is making them look bad at. And so the only thing last time we had inflation like this, I remember I was in 7th, 8th grade. I remember when Jimmy Carter was president, and they just kept raising the rates until they paralyzed the economy. But it was a different time then. It's going to be really tough for them to continue, but that's the only thing they're focusing on. I think eventually they'll see the light. But what they have to get is that they pumped, in the last 2.5, well, at least the last 2 years, 18 months to 2 years, over 2.5, 2.6, $2.8 trillion, and now they just got another 800 billion. You can't keep putting money into the economy like that and not expect inflation. 20% of the money in circulation, like in this country, has been put in the last 2 years. People don't realize that. That's huge. That's part of the problem. So it's like they fuel their own problem, and then they, when you say I don't want a recession, but I'm slowing things down, that's like I'm not schizophrenic and neither am I. I mean, it doesn't make sense. Right? So
no, you're absolutely right. And looking at the 10-year Treasury today, it continues to climb. It sits at 3.78 this morning. So where it goes, nobody knows. But I absolutely agree with you. They're hell bent, and they've only got one thing in front of them, and I don't think they see the ripple effect that it's having as they throw the stone into the water every couple of months.
I totally agree, but that's why they're not running a real business, because you make a mistake, you just print more money. That's called government.
Absolutely. All these people that we had a lot of people think that the money that was being given out during COVID was free. And I told people, nothing is ever free. You'll always pay for it at some point in your life.
Yeah. Just like the student debt. And I have two kids that are ecstatic. And I'm like, I like that you guys got some money. One of them, it made him even. The other one cut down more than half his debt. But I go, when you get my age, you're going to go, that was the dumbest thing, because, it's not that it's going to be paid for just by the taxpayers, not by the individuals, which is kind of weird when you think about it. But hey, whatever. They're running the government. I'm not. We're selling real estate, and you're getting mortgages to people who want to buy it. So I guess we'll stay in our lane. Doesn't mean we won't complain.
Absolutely.
But All right, Thomas. Any final words you want to leave these wonderful people today?
No, I really appreciate you having me. Like I said, don't be afraid of what you're reading in the news or what you hear. You're more than welcome. I always encourage customers, reach out to me. Let's chit chat. Let me know what your fears are. Let me see if I can calm you down and, be able to answer all of your questions. Like I said, so many people are scared what they read in the newspaper, what they see on the
Yeah.
news, so on and so forth. There's a lot more going on. You really need to peel that onion, and that's why us loan officers are here. Anybody who's ever got any questions on the market, where it's going, what can I do, how can I make it better, definitely feel free to leverage me and reach out. I'm always available.
I love it. And to make yourself feel even better, rent a movie called The Big Short. Watch that movie and then ask yourself, are we in a situation like that? And you'll go, of course not. Okay, so that movie is so accurate, it's scary. The Big Short. Everybody should watch that as a loan originator or as a realtor from 2007 and 8. It's actually even a good movie too. It has some funny parts and it's a pretty good movie. Scary, but it's dramatically as accurate as Hollywood can be, but it's definitely a good movie to watch.
It certainly is. That one I'd also suggest that Too Big to Fail is a really good one as well.
Yeah, there's a good one too. Yep, you're right. All right, Thomas. All right, everybody. Thomas from Prosperity Mortgage works in Temecula Valley. Give him a shout. Okay, give him a shout and use him. He's a dynamite. Plus, we both work for two great companies, Prosperity and Berkshire Hathaway. All right, Thomas. Thanks for your time today, everybody. We'll do this again next week, and I'll see you on Wednesday, Thomas. Looking forward to it.
Sounds good. Have a great day. Thank you, Rick.
You too. Bye-bye. Okay. Bye-bye.